Welcome to the Financial Channel Frontiers, where we explore the vast landscapes of finance and investing. Today, we set our compass towards the horizon of retirement planning. This is an essential journey we all must undertake, charting a course that ensures a tranquil sunset to our working years. Our voyage will navigate through the intricate maze of long-term investments, dissect various retirement plans, and illuminate saving strategies that can secure a comfortable retirement. Retirement planning is akin to planting a tree. The earlier you plant the seed, the larger the shade you can enjoy later. It's about building a nest egg that can sustain you when the hustle and bustle of your career recedes. It's about ensuring that your golden years are truly golden. So let's embark on this enlightening journey together. By the end of this video, you will gain valuable knowledge on how to effectively plan for your retirement. Retirement planning is not just about saving money, it's about building a secure future. Let's delve deeper into understanding retirement planning. Picture it as a blueprint for your future. A future where you're not working, but living off the fruits of your labor. It's a strategic roadmap outlining how you'll provide for yourself in your golden years. Retirement planning is crucial because it ensures that you have enough resources to maintain a comfortable lifestyle once you stop working. Whether it's traveling the world, pursuing a hobby, or simply enjoying your time with family, your retirement years should be about relaxation and enjoyment, not worry and financial stress. Now you might be thinking, why is financial security during retirement so important? Well, it's simple. As you age, your earning potential decreases, but your expenses, particularly healthcare costs, tend to rise. Without a solid plan, you risk outliving your savings, which can lead to a lower quality of life during a phase when you should be enjoying your well-earned rest. The role of retirement planning in achieving financial security is like that of a compass guiding a ship. It helps you navigate through your working years, making informed decisions about saving, investing, and spending. It's about setting financial goals, understanding your time horizon, and managing risk. By planning for retirement, you create a safety net that cushions you from unforeseen circumstances. It gives you the freedom to make choices based on what you want, rather than what you need. Retirement planning isn't a one-size-fits-all approach. It varies depending on your income, lifestyle, family obligations, and aspirations for retirement. Therefore, it's essential to tailor your plan to your unique situation. The beauty of retirement planning is that it empowers you to take control of your financial future. It's about making decisions today that will impact your tomorrow. Remember, retirement isn't about ending a career. It's about beginning a new, exciting chapter of life. Remember, retirement is a long vacation in your future. Plan well, and you'll enjoy it. The early bird catches the worm, and the same applies to retirement planning. Now you might be wondering, why should I start planning for my retirement so early? Let me tell you, there's a world of difference between starting your retirement planning in your 20s and starting in your 40s. To understand the importance of starting early, we need to dive into the magical world of compound interest. It's not just about the money you save, but also about the interest you earn on your savings, and then the interest you earn on that interest. It's a snowball that keeps growing and growing. Imagine two people. Person A starts investing $100 a month at age 25, and person B starts doing the same at age 45. By the time they both hit retirement at age 65, person A will have amassed a significantly larger sum than person B, even though they both invested the same amount each month. That's the power of compound interest. Now, I'm not saying you need to have it all figured out in your 20s, but the sooner you start, the more time your money has to grow. It's about giving your money the longest possible runway to take off and soar to unimaginable heights. Starting early also gives you the flexibility to take risks. When you're young, you can afford to invest in riskier assets that might yield higher returns. As you age, you can shift your investments to safer, more stable assets. Moreover, starting early instills financial discipline. It encourages you to live within your means, to save more and spend less. This habit will serve you well throughout your life, not just in retirement. So don't delay your retirement planning. There's no time like the present to start building your nest egg. Remember, every dollar you save today is a step towards a comfortable and secure retirement. The sooner you start planning, the more relaxed your retirement will be. When it comes to retirement planning, it's a marathon, not a sprint. With that in mind, let's delve into the world of long-term investments. These aren't quick fixes or get-rich-quick schemes. They are calculated decisions that require patience, endurance, and a clear understanding of the financial landscape. Firstly, let's talk about stocks. When you buy a stock, you're essentially purchasing a small piece of a company. Over time, as the company grows and succeeds, so does your investment. Of course, the opposite is also true. Hence, Investing in stocks requires careful research and a keen eye on market trends. But, when played right, stocks can be a powerful addition to your retirement kitty. Next, we have bonds. If stocks are like buying a piece of a company, bonds are like lending money to that company or to the government. In return, you receive regular interest payments and the promise to repay the original amount after a certain period. Bonds are generally considered safer than stocks, making them an attractive option for the risk-averse investor. Then, there are mutual funds. Think of them as a basket of various investments managed by a professional. This basket could contain stocks, bonds, or other types of investments. The beauty of mutual funds is that they offer diversification. Instead of putting all your eggs in one basket, you're spreading the risk across multiple investments. And with a professional at the helm, you can focus on your day job while your money works for you. Lastly, let's explore the realm of real estate. Buying property can be a great long-term investment. Over time, real estate tends to appreciate in value, and you can earn a steady income through rent. Moreover, it's a tangible asset, something you can see and touch, which adds a certain comfort factor. Each of these investment types has its own set of pros and cons, and what works best for you will depend on multiple factors. Your risk tolerance, time horizon, financial goals, and market conditions all come into play. It's crucial to do your homework, perhaps even seek professional advice before diving in. Remember, the goal isn't to become an overnight millionaire. The goal is to build a robust retirement fund that can support your lifestyle and aspirations in your golden years. And that, dear listeners, requires a slow and steady approach, one that values long-term gains over short-term windfalls. So, whether it's investing in the next big tech company, lending money to the government, trusting a professional with a diverse portfolio, or buying that beachfront property you've always dreamed of, long-term investments can play a crucial role in your retirement plan. To reiterate, investing for retirement is not a race against time, but a journey of careful planning and strategic decisions. Long-term investments are the fuel that drives the engine of your retirement plan. Retirement plans are your roadmap to a financially secure future. They are the vehicles that drive you towards your golden years, ensuring you have a cushion of funds to fall back on. But, like all journeys, the route you choose can significantly impact the comfort and ease of your travel. Picture this: you're planning a road trip. You could take the scenic route, which, while longer, offers beautiful vistas and a leisurely pace. Or you could opt for the expressway, a quicker, more direct path. Both will get you to your destination, but your experience along the way will differ immensely. Now, apply this analogy to retirement planning. There are several routes you can take, each with its unique advantages and caveats. Let's navigate through some of these paths, shall we? First up, we have the 401k plan. Think of it as your expressway to retirement savings. It's a plan offered by many employers where you contribute a portion of your pre-tax salary towards your retirement fund. This route not only decreases your current taxable income, but also allows your investments to grow tax-deferred. Plus, many employers offer a matching contribution, which is essentially free money towards your retirement. Next, we have the individual retirement account, or IRA. It's akin to the scenic route of retirement planning. An IRA is a tax-advantaged account you set up independently and can offer greater investment flexibility. Your contributions may be tax-deductible, and the earnings can grow tax-deferred until you withdraw them during retirement. But what if you could take a path that offers tax-free growth and tax-free withdrawals during retirement? Enter the Roth IRA. This is like taking the road less traveled. With a Roth IRA, your contributions are made with after-tax dollars, meaning you won't get a tax break up front. But the trade-off is that your money grows tax-free, and withdrawals during retirement are also tax-free. Last but not least, we have pension plans or defined benefit plans. These are the old-school, traditional paths to retirement. Your employer guarantees a specific retirement benefit based on your salary and years of service. It's like having a tour guide who knows the route like the back of his hand. But remember, not all employers offer pension plans, and they may come with their own set of rules and restrictions. In the end, the path you choose depends on your individual circumstances, financial goals, and risk tolerance. Each plan comes with its own set of tax implications and withdrawal rules. It's essential to understand these aspects before you set off on your journey. Choosing the right retirement plan can make your journey to retirement smoother and more comfortable. It's about finding the balance between enjoying the present and preparing for the future. So choose wisely, and happy journeying towards your golden years. Saving for retirement is not a task, it's a habit. This phrase encapsulates the essence of our approach towards retirement savings. It's about weaving those savings habits into the fabric of our daily lives. rather than viewing it as an isolated task to be ticked off a to-do list. To start, let's talk about budgeting. It's the backbone of any successful savings strategy. A well-planned budget not only helps you understand your income and expenses, but it also paves the way to identify potential savings. It's about making conscious decisions on where your money goes, prioritizing needs over wants, and setting aside a specific portion of your income for retirement. It doesn't have to be a large amount initially. Even a small percentage consistently saved can make a significant impact in the long run due to the power of compound interest. This brings us to our next point, the importance of reducing debts. Debt is like a leak in your savings bucket. The more debt you have, the more of your hard-earned money is drained away in the form of interest payments. Prioritizing debt reduction, particularly high-interest debts, can free up more of your income for savings. Think of it as a two-pronged approach. While you're working on increasing your savings, concurrently work on decreasing your debts. It's like fighting the battle on two fronts, but it's a battle well worth fighting. Next, let's discuss the importance of consistently contributing towards retirement funds. This is where the habit part really comes into play. It's easy to get swayed by the immediate gratification of spending, but we need to cultivate the habit of consistently setting aside a part of our income for retirement. Whether it's through employer-sponsored retirement plans, individual retirement accounts, or personal savings, the key is consistency. Remember, it's not about the amount you save, but the habit of saving. Take advantage of automatic contributions if your employer offers it. This way, a part of your salary goes directly into your retirement account even before you see it. It's a simple and effective way to ensure consistent contributions towards your retirement fund. And finally, consider diversifying your savings. Don't put all your eggs in one basket. Spread your savings across different types of investments and retirement accounts to minimize risk and maximize potential returns. Diversification can help you achieve a balanced portfolio that aligns with your risk tolerance and retirement goals. In a nutshell, saving for retirement involves thoughtful budgeting, reducing debts, and consistently contributing towards retirement funds. It's about making wise financial decisions today for a secure and comfortable retirement tomorrow. So, as we journey together on this path of financial planning, let's remember the power of small, consistent steps. Let's remember the importance of habits. And most importantly, let's remember that every penny saved today is a step closer to a secure retirement. That's the ultimate goal, isn't it? And it's within our reach if we make the right moves today. Remember, every penny saved today is a step closer to a secure retirement. In the journey of retirement planning, it's important to avoid pitfalls. As we navigate the winding road to a secure retirement, it's crucial to steer clear of common errors that can potentially derail our plans. Let's delve into some of these missteps and explore how to bypass them. First on our list is procrastination. Many individuals delay retirement planning, believing there's always tomorrow. However, the power of compound interest decreases with time. So the earlier you start, the better. Break free from the "I'll do it later" mindset and take the first step today. Next, we have the one-size-fits-all approach. Remember, every individual's financial situation, goals, and risk tolerance are unique. So a retirement plan that works for your friend might not necessarily work for you. Tailor your plan according to your specific needs and circumstances. The third mistake to avoid is putting all your eggs in one basket. Diversification is the key to mitigating risk in your investment portfolio. Spread your investments across a variety of assets such as bonds, equities, and real estate to cushion any potential financial blow. Another common pitfall is ignoring inflation. The purchasing power of money diminishes over time due to inflation. Therefore, your retirement savings should grow at a rate that outpaces inflation. Otherwise, you might find yourself falling short when it's time to retire. The fifth mistake to sidestep is neglecting healthcare costs. As we age, our healthcare needs escalate, and so do the expenses. A solid retirement plan should account for these inevitable costs. Lastly, not seeking professional advice can be detrimental. Financial planning can get complex, and mistakes can be costly. A financial advisor can provide valuable insights and help you craft a retirement plan that aligns with your goals. Steer clear of these mistakes, and you're on a clear path to a secure retirement. Remember, retirement planning is not just about crossing the finish line. It's about enjoying the journey, and more importantly, the destination. Scene script. Let's recap what we've learned today. We began this journey with a look at the basics of retirement planning. We discovered that it's a process, a roadmap, if you will, to a financially secure future. It's about more than just putting money aside. It's about understanding your needs, your goals, and the financial requirements these will demand in your golden years. The critical takeaway here is the importance of starting early. We learned that the earlier you begin, the more time your money has to grow. Think of each dollar as a tiny seed. When you plant it and nurture it from an early age, given enough time, it can grow into a mighty tree. The magic of compound interest works much the same way. The more time you give your investments, the more they can grow and multiply. We then dove into the world of long-term investments. It's not just about saving money, it's about investing it wisely. We learned about stocks, bonds, mutual funds, and real estate as potential avenues for investment. The key here is to diversify your portfolio. This helps to spread out the risk and increase the potential for growth. Remember, it's not about chasing the next big thing. It's about steady, consistent growth over time. Next, we explored the various retirement plans available. From employer-sponsored plans like 401(k)s to individual retirement accounts, IRAs, there are a plethora of options out there. Each comes with its own set of advantages, tax implications, and rules. The important thing is to choose the one that aligns best with your retirement goals and current financial situation. We also delved into some effective saving strategies for retirement. We learned that it's not just about how much you make, but also about how much you save and how you manage your money. We talked about automating your savings, living within your means, and the importance of having an emergency fund. We also discussed the significance of eliminating debt and avoiding unnecessary expenses. Finally, we took a look at some common mistakes to avoid when planning for retirement. We learned that putting off retirement planning, not taking advantage of employer matching contributions, and withdrawing from your retirement funds prematurely can have serious financial consequences. The key takeaway here is to stay informed, stay disciplined, and stay focused on your long-term goals. In conclusion, retirement planning is about more than just money. It's about security, peace of mind, and the freedom to enjoy your golden years without financial worry. It's about taking control of your financial future and making informed decisions that will benefit you in the long run. Remember, the journey to a secure retirement is not a sprint, it's a marathon. It takes time, patience, and consistent effort. But the reward of a financially secure retirement is well worth the effort. Remember, retirement planning is not a destination, it's a journey. Start today and secure your future. Thank you for joining us on this journey at the Financial Channel Frontiers.